Geez, NSCC is coming in heavy with these filings. We got NSCC 2021-011, remove ID net transactions from the required fund deposit calculations and make other changes to the rules. This kind of goes hand in hand with the SFT one we had come out. Let's go ahead and take a look. So the purpose of this one is to revise its margining methodology to remove institutional delivery transactions that are processed through the ID net service from the calculation of members' required deposits to the clearing fund as described in greater detail below. While ID transactions processed through the ID net service are netted with transactions that have been processed through NSCC's continuous net settlement system, which we discussed in the SFT filing, these transactions are not subject to NSCC's trade guarantee. Therefore, the proposed change would improve NSCC's ability to collect required fund deposits from its members that more accurately reflect the positions that it may be required to complete in the event of a member default. Now, I find it odd that they're specifically changing language to make it known that these transactions are not subject to guarantee, but then they leave a super note that says that they've never been guaranteed, kind of making this whole filing pointless, or at least this aspect of it. So I'll take that with a grain of salt. Now, the proposed change would improve NSCC's ability, again, to collect fund deposits more accurately. Now, why would they need that? Well, in the case of a member default. So let's go ahead and take a look at the overview of the ID transactions and the ID net service and what it is. So ID transactions, first of all, are the parties involved are mutual funds, insurance companies, hedge funds, bank, trust, and pension companies. Those are going to be the parties involved that include the institutional investor. So institutional investor is the mutual funds, insurance companies, hedge funds, bank, trust, and pensions. The buying broker and the selling broker and the custodian banks are the investment managers. After execution, which is the buying and selling of shares, the trade allocation details of ID transactions are matched between the executing broker and the investment manager or institutional investor's custodian bank. After an executing broker has provided a final notice of execution, most investment managers will provide client trade allocation details to the executing broker using a service provided by NSCC's affiliate, Institutional Trade Processing, or ITP. Now, when the executing broker accepts and processes the trade allocations, an electronic confirmation is provided through the ITP's Trade Suite ID service to the investment manager or the broker, selling broker, custodian banks. The ITP links with the various parties to institutional trades to provide real-time central matching electronically, comparing trade details and notifying parties of any exceptions. Now, it says exceptions occur when the mandatory matching fields do not match. After the trade allocation details are affirmed, the institutional delivery details are sent to the depository trust company, or the DTC, where then they are finally settled. Now, NSCC Risk Management receives a daily feed from ITP that includes both ID transactions that have only been confirmed, as well as those that have been affirmed. Now, overview of the ID transactions and net settlement continued. Participation, of course, is voluntary. Now, eligibility, how you would be eligible to use this service, the broker-dealer in the ID transaction has to be an NSCC member and a participant of DTC. The custodian bank in the ID transaction must be a DTC participant. In addition, eligibility for ID net service processing is based on the underlying security being processed, the type of transaction, and the timing of affirmation. As described in Procedure XVI, net transactions are not completed by the cutoff time. If they are not completed by the cutoff time, which is currently 11:30 a.m. Eastern, then the NSCC systems will exit those transactions, and at that point, they must be settled on a trade-for-trade basis away from the NSCC. Now, basically, what the service does in a nutshell, it provides members with operational benefits, we discussed earlier, of netting these transactions with their CNS or continuous net settlement obligations, allowing them to combine their affirmed ID transactions with other trades in the CNS. As noted above, ID net transactions are not subject to NSCC's trade guarantee. So again, to roll through this slide, the main point of this slide is they're not subject to the guarantee from NSCC. The ID net transactions not completed by the cutoff time at 11:30 a.m. East and are not if they're not completed by that time, they have to be settled away from the NSCC. It's a voluntary service, and it creates operational benefits by netting the transactions to lower the required capital costs for their fund deposits. Now, the required fund deposit and risk management of the ID net transactions. As part of its market risk management strategy, NSCC manages its credit exposure to members by determining the appropriate required fund deposit to the clearing fund and monitoring its sufficiency as provided for in the rules. The required fund deposit serves as each member's margin. So think about that. The required fund deposit serves as each member's margin, and they're taking away ID net transactions from being included in that calculation. The required fund deposit serves as each member's margin. The objective of a member's required fund deposit is to mitigate, there's that word again, mitigate potential losses to NSCC associated with liquidating a member's portfolio in the event NSCC ceases to act for that member or defaulting. So a defaulted member or a member that NSCC has failed to act for or ceases to act for is therefore designated as a default member. Now, the aggregate of all members' required fund deposits constitutes the clearing fund of the NSCC. Now, the NSCC would access or dip into the clearing fund should any defaulting member have insufficient funds or an insufficient required fund to satisfy the losses to NSCC caused by the liquidation of that member portfolio. So number 10, the Supernote 10 here says the rules identify when NSCC may cease to act for a member and the types of actions NSCC may take. For example, NSCC may suspend a firm's membership with NSCC or prohibit or limit a member's access to NSCC services in the event that member defaults on financial or other obligation to NSCC. Pursuant to the rules, each member's required fund deposit amount consists of a number of applicable components, each of which is calculated to address specific risks faced by NSCC and are described in Procedure XV of the rules. Because ID net transactions are netted with CNS transactions, these transactions are currently included in the netted positions that are used to calculate certain components of the member's fund deposit. These components include the volatility component, the mark-to-market component, and the MRD charge. Now, those are what's currently included to the fund deposit, right? Well, they're getting rid of the mark-to-market component and the MRD charge. The proposed enhancement to NSCC's margin methodology is described as follows. ID net transactions no longer will be calculated into the required fund deposit. In the event of a member default, these transactions will now be settled away from NSCC. NSCC can now collect an amount that more accurately reflects the risk. Therefore, they get more back. The people who made the bad bets or the people that took in all the risk get the hit. So this is great. So basically, they're proposing to enhance its margining methodology to remove the ID net transactions from that required fund deposit. NSCC does not guarantee the completion of these ID net transactions, so in the event of a member default, they're excluded from the operations to be settled away from NSCC. By removing ID net transactions from the calculation of members' required fund deposit, NSCC would be able to calculate and collect an amount that more accurately reflects the risks presented by positions it would be obligated to complete in the event of a member default. Now, I wonder what they mean by complete. So continuing on with the margining methodology enhancements. So in order to implement the proposed change, they're going to obviously remove the ID net transactions from the member's net unsettled positions for purpose of calculating the volatility charge and the MLA charge. NSCC would also eliminate the ID net mark-to-market charge from the required fund deposit. They would also remove, or they would amend the section IA1B of Procedure XV to make clear that ID net transactions are not included in the calculation of the regular mark-to-market charge. And other than that, they're not proposing any other changes to the calculation of these margin charges. They're just getting rid of those two main ones. Remove the ID net transactions, eliminate ID net mark-to-market charge. And the market-to-market charge, what that does is it measures unrealized gains and losses versus current market price. So proposed changes to clarify the non-guaranteed status of ID net service. Like they have a whole section for this, right? But then they go on to say that it's always been this way. I find that odd. So first, they're going to include a statement in new section 5C of Rule 65 that states that the ID net service is not a guarantee. So again, it's always not been a guarantee, but now they're actually adding to the rule saying that it is not. So I don't know if I buy that. And refers to Rule 18 of the rules to describe how the ID net transactions would be treated if NSCC ceases to act for a member, or member default. That is an ID net subscriber. Now, second, NSCC would amend Section 2A of Rule 18 of the rules to make it clear that uncompleted transactions processed through the ID net service in accordance with Rule 65 would be excluded from NSCC's operations if NSCC ceased to act for a member that is an IDNet subscriber pursuant to Rule 46 of the rules. By using parallel language and describing the nature of each of these services as non-guaranteed and how transactions processed through these services would be excluded from NSCC's operations following member default, the proposed change would create consistency and clarity within the rules, improving the rules' transparency to members. Other proposed changes, you can read this if you want, pause the video. This one's getting a little bit longer than I'd like it to be anyway. Implementation timeframe is going to be 10 business days after the SEC approves it. So as soon as the SEC gives an approval, or we see the on their Fed register, as soon as we see notice of filing or approval for this rule, we have 10 business days from that date. And to sum this all up, basically, they're making it a lot more difficult for these institutional firms to hide their bullshit. So they can't net settle their crap anymore and go through the NSCC. Not going to happen. So you see the language. They're all concerned about member defaulting. NSCC is really taking into account that it's assuming a lot of risk. It's got to ensure that everything is in perfect line to where they don't get blown up because of this. And that's exactly what it looks like is going on here. So we've had 803, 010, 011 all from the NSC. Then we had the FINRA notice 21 through 27 on Thursday last week. And then we had 014 on Thursday last week. So last Thursday, all on the same day, FINRA notice 2127, NSCC 803-010, and DTC 014 all came out at the same time, all pertain to the same information basically. And then we have this one come out today that basically, seals the deal there. So very, 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 very interesting filings we got here, guys. So hope you enjoyed this one. I will talk to you all later, and I hope you have a good evening.